Want to learn how you can get rich through real estate? Well, let me introduce to you a man behind a real estate investment business that controls over 4,800 plus units and the leader of Hui Deal Pipeline Club, which has acquired over $600 million of real estate by syndicating over $70 million of private equity since 2016. Hi, it's Lynn, and in today's video, you will learn from Lane Kawaoka how you can get started in real estate and become the next millionaire. So good to have you here.
Hey, thanks for having me, Lynn.
No worries. Well, you're such a guru around the real estate thing because when I looked up your name, you're everywhere. You're on so many podcasts. And in today's episode, I want to help people, including myself, how to become a millionaire just through real estate mainly, right? And what I love about reading your profile and things is that you just really want to help everyday professionals who are busy working and yet they can still build a portfolio and succeed. So let's start with what motivated you to get into this business of helping people invest?
I kind of started on this linear path, go to school, study hard, get a good job. I eventually became an engineer and I didn't like my job, right? It sucked, as most W-2 people who kind of go to more entrepreneur ventures. But I bought a house to live in, and something that I don't necessarily agree with as a good financial decision, but I was never home because I was traveling all over for work when I was first starting my career. And that was where I got the idea of like, well, this is kind of silly having this big house to myself. Let me just rent it out. And that was where I got this taste of cash flow. The rents were $2,200 a month. The mortgage was $1,600. I knew nothing about rent to value ratio, the 50% rule we can talk about. I just knew I was putting some nice beer money in the bank account every single month. And I was like, shoot, this is pretty nice. And then after a while, I realized, wow, if I just did this a few more times, I'll be able to fire my boss, quit my day job.
You then decided that I can just do this for people. Is that right? So what do you actually do now in your business? Like what services do you offer?
I realized it's not that hard, right, to do this. It's actually kind of simple, right? And that was the idea of simplepassivecashflow.com to kind of educate people on how to get started with it more on the passive investing side. Instead of all that house flipping nonsense you hear about a lot, like there's just more people who don't have successful businesses or good paying jobs. There weren't many people talking to folks like professionals like myself, how to do this from a passive standpoint. So today, I kind of have two sides of my business. We operate apartment complexes, bring people in as investors. We do value-add real estate where we get dividends and cash flow, and then we also force appreciate the properties by improving them, making communities better in the process. And then the other side is the consulting. I run a mastermind with high net worth accredited investors, and we kind of teach them how to vet deals, who to invest with, who to stay away from, the tax, the legal tactics called like infinite banking, and a lot of these things that the wealthy do that I kind of discovered by interacting with really, really wealthy, smart people. And I discovered like a lot of these things are very simple. It's just very counterintuitive than what my parents taught me or what my old coworkers thought.
Okay. So tell me, what was one of the common thing that we feel complicated in the world and yet it's simple to you? Because I know you mentioned simple a few times, but I don't know which part is simple compared to what others have tried to confuse us with.
Yeah. So like the on-ramp to this stuff is, buying a rental property, right? If your net worth is under $250,000, $500,000, to me, I think, you should just go buy a simple rental property that cash flows. And that's the important part. Normally, we kind of set people up buying properties that are in the $100,000 price point that rent for $1,000 a month. We look for this percentage ratio called the rent to value ratio of 1% or higher. So you take the monthly rent divided by the purchase price. We're looking for that 1%. A lot of places, I think Australia is not the best place to invest, in my opinion. Just like a lot of Asia, Europe, your rent to value ratios just ain't gonna work. Very similar to like Seattle, California, Hawaii, New York. You'll be lucky to buy a place in the ghetto for $400,000 that rents for $2,000 a month or higher, so that this asset can create cash flow on the month-to-month basis. And there's going to be repairs, vacancy, things that happen. But that's why you want a cash flow on a month-to-month basis so that you can pay for those. But also what you're doing is you're creating streams of income for yourself. And this is very counterintuitive for what I think most people invest for appreciation, buy low, sell high, which seems intuitive and obvious. But to me, I think I call that gambling. right? Like I want the sure thing, which is monthly cash flow.
Okay. But then what do you say about people, well, including myself, believing that every 10 years it always doubles? So I am that kind of person that just looks at appreciation and had no idea that there was a math number of 1% to look out for. What do you say about the whole appreciation expectation?
Typically, real estate does go up in price, right? Like typically it does. But look, I'm not a gambling man. I don't need to gamble anymore. You can't eat appreciation. You can't put food on the table. You can't pay for groceries. You can't pay for rent on your own house with that. And that's the difference between cash flow, right? Cash flow is like the streams of income that you can use to sustain your life. And for me, when I was starting off, it was like, well, how do I quit my day job, right? Well, I need cash flow to replace my income. I can't do that if I buy a property in the hottest part of Seattle that's going to appreciate, even though that seems really obvious. I need cash flow. So I started to look in properties in these less obvious areas such as Birmingham, Atlanta, Indianapolis, Kansas City, Memphis, Little Rock, like the less sexy areas, right? Where you don't have price inflation. You know, it's just two ways of doing things, right? Like a real estate is such a great thing that I think you can have that appreciation strategy and gamble, and you're going to do well, right? On the long run. But to me, my goals are different, right? It's sustainability, cash flow.
I really like that idea. I mean, yeah, at the end of the day, like when you have cash flow coming in, you can actually do something with it. You mentioned earlier on about not buying a house to live in and rent instead. So then where would you actually live though?
Well, you pay for rent, right? And I think the obvious thing that comes up that we're all kind of brainwashed to think is like, well, rent's throwing money down the tube, right? Well, it kind of is, but if you're taking that money for the down payment and your large mortgage payment and you're buying 4 or 5 houses in lieu of that now you're having 4 or 5 families pay for your mortgage with their heart, sweat, and tears, and you're getting the appreciation with 4 or 5 properties, and you're getting cash flow for 4 or 5 properties, and you're getting tax benefits for 4 or 5 properties. You can see where I'm going with this, right? Yes. It's ultimately an arbitrage. Now, I think most people in the world, sadly, are not very good with their money, right? They don't make that much money, or they don't save very much. And I think for those people, the Susie Orman and Dave Ramsey advice out there, buy a house to live in, is probably what they should do, because it becomes a forced savings account. But for a minority of people out there, a lot of people in my tribe, there's, a lot of these guys are the guys who max out their retirement accounts. They save $30,000 to $60,000 a year. They have successful business, can put multiple 6 figures in the bank as profits. I mean, for them, it's better to go on the offense and rent your house to live in and invest. Ultimately, it's just an arbitrage game.
Then because it's always cash flow positive properties, does it mean the bank always lets you borrow easier?
Yeah, and that's the crazy thing, right? Because your debt service coverage ratio improves every single time, right? As you kind of go along on this road.
But then obviously you just said Australia, there's not much to buy in Australia. So then if I was an Australian client, is it possible for me, or is this all American? And what kind of areas are you looking at that you can find all those positive cash flow ones?
I suspect there are places in your guys' country where you can find some cash flow and a little bit off the beaten path. That kind of opens up the world of like, today I invest more like an accredited investor as a syndications and private placements. So in 2015, when I had 11 rental properties, a few $100s of cash flow for each property, it's not much, right? But it adds up to $3,000 a month. I mean, I'm not complaining or anything. $3,000 a month is great, but I don't know what American, Australian family can survive off $3,000, right? Let's face it. So and just to give a little bit insight into operating 11 rentals, I had professional property management doing all my stuff for me, right? Again, you don't want to be a landlord. That's what normally people do. You hire professionals to do your dirty work for you. So I had maybe an eviction or 2 every year, some kind of big catastrophe, like a tree falling on the house, the plumbing repair every quarter, which is fine because the property manager takes care of it. But, I need 30 houses, right, to get $10,000 a month. Eviction every other month, and now that equates to big catastrophe every other week. I quickly saw the writing on the wall, and I started to join different masterminds, up level my network, and I started to get around other high net worth doctors, lawyers, engineers further along the road as myself. And I discovered that a lot of these guys invested as passive LP partners into large syndication deals. So larger deals, more robust, outside of the realm of mom and pop investors where they just bid up prices. So a little better deals, And then the beauty was, as a passive investor, you don't have the liability, right? You're not a managing member. You don't take on any of the asset management duties. There's really nothing that you do. You just invest. You partake in the upside, and then you get all the great tax benefits along go with it. And you don't get any debt in your own name. So like you were asking earlier about what do you do with the debt? Well, you don't get any debt in your name. It's all in the general partners and the key principals are putting their name on the loan.
Oh, okay. So you're investing a smaller portion, but you're going into a big pool of money that then allows as the syndicate to go and invest in bigger apartment blocks, right? And then
Right.
gives you back cash flow. So here is the game of cash flow. And so you're trying to say to me also that you can start with anything? Like, well, how much would it take to kind of start investing?
Typically, the minimums in our industry are like $50,000 minimums. And for the most part, it's more advisable that accredited investors partake, right? And accredited investors in America, that's a kind of a loose definition here. It's like you make over $250,000 a year, or you have a net worth of $1 million. And it's a kind of a frustrating law put up by our SEC that, they're just trying to protect the average Joe who 20 grand in his bank account, and that's all he has, to make a frivolous decision on some, bad operating, right? And invest with the wrong people. Unfortunately, it kind of takes a lot of people out that are level less than $1 million net worth. They just don't get access to these good opportunities. The truth is, most deals do accept non-accredited investors, lower net worth, but you have to be in the network and have a pre-existing relationship with the operator. So again, it's like the whole network is your net worth concept.
Okay, so I'm assuming someone watching this, they do have $50,000, and you're saying also that it's not like you go and borrow the bank for the 50. Like you should save up 50 and have 50 to play with, right?
Right, because the syndicators are going to use your money for the down payment and the rehab and the value add, and then go get a bank loan on top of it.
Yeah, because then if you're owing money on that 50K, then that kind of defeats the purpose of getting the cash flow from that deal.
Right. Well, the more leverage, and that's another concept that a lot of people, most people are very debt adverse, right? Well, to me, especially with inflation all here wreaking havoc on people unable to go into deals or buy assets that go up with the pace of inflation, such as real estate, it's another example where the rich are getting richer and the poor are getting poorer. In these deals, the debt is probably the most valuable thing. Right? Locking up long-term debt, paying it in the future with dollars that are worth way less. That's how the wealthy do it. That's how banks do it.
Okay, so let's say I invested 50K today with you guys and you invest into a property complex. Then when does the cash flow actually come in? And then when it starts to come in, what's the next action for that investor?
Every deal is a little bit different, right? But we like to go into deals where we're stabilized, so 90% occupied or more, so we can get really good debt on that. And the banks love those more because it's less risky for them too. But typically projects will cash flow anywhere from single digits returns for the most part. That's nice, right? But the big thing is the value add, right? What we do is we do relatively light to medium value add. So you put in $4,000 to $6,000 to every unit. So it's not much money, right? But when you do it times 100 or 300, you get really good economies of scales. What we do is we change out the flooring, put that nice LVT. It's cheap, but it looks really nice. New appliances, change out the yellow appliances and put the stainless steel or just the black or the white one. New paint job, new playground equipment, trying to improve the community, kick out the deadbeats, so we can bump the rents up maybe 10-20% overall. But as in any business, right, this is why I like commercial real estate as opposed to residential real estate. Commercial real estate's the price is dictated on net operating income, or for your business owners that are listening, it's like your EBITDA divided by the multiplier in our world, the cap rate. So if I can increase the income or decrease the expenses, that ultimately increases the price of the property, which I can harvest if I refinance or sell the property. So a lot of times, the way we do it is we don't kick out tenants. We just kind of wait till they naturally leave, which will take a couple of years. But in that natural turnover, we'll rehab units and slowly rehab the property. So it's kind of like a slow flip. It actually is incredibly boring, kind of waiting for the thing, but this is kind of why in the meantime, we just cash flow.
Okay, so if you've put in 50K, is the cash flow, you're saying single digit. Can you give me a clear number? Like if I put in 50, what would be a monthly income that I'm looking at? And then with that income, like what would be my next step to building my wealth? So the goal is I want to be a millionaire in how long do you reckon I could be if I'm that average professional working?
I mean, I'm kind of dodging the question a little bit because we have some securities law here in the United States, so you got to be careful. But so, again, using the generalities, right? Like a deal that cash flows, just say 8%, right? But that's only that's a minority part of how you're making your money. Most people in our world, they'll pay quarterly, not monthly, because, this is the nice thing about these deals is there's less overhead. We're not large institutions doing this, therefore better returns, right? If you want to go work with an institution that has a whole bunch of bloated staff to cut out monthly checks, well, you're going to pay for it as an investor. It's going to come out of your pocket, right? I mean, so the type of projects are kind of ran like co-ops in a way. It's optimized for investors' returns, right? Very light overhead, as minimal as possible. So, if you're looking at an 8% return a year, you're looking at 2% coming back at you every quarter. So on 100 grand, $2,000 checks 4 times a year. And that kind of continues as the rehabs are happening. But as these rehabs are happening, as you increase net operating income, you're able to extract a whole bunch of income there. What we try and do is our goal, the way we underwrite deals, is we try and double the investor's money in 5 years. And that's made up of cash flow plus course appreciation. Typically, every deal is a little bit different, right? Where some deals might have more cash flow, a little bit less value add. Some deals might be very fat too. But I would say maybe 2/3 of the money comes through the force appreciation part, 1/3 comes through the cash flow. So you might get 30% from cash flow in the 5-year period, but 60 to 70% coming back at the sum.
Yeah, and also technically you own part of this property or asset, right? That is the asset, and then when you flip it or get sold, that's where your money comes back and more. Is that right?
Right. I mean, the way we do things, it's a syndication, so money is pulled together. There's a general partnership, limited partnership class. You can syndicate a brewery, you can syndicate an e-commerce business, you can syndicate a real estate development, real estate value add, right? Essentially, what you're doing is you're owning a piece of the company. And in this case, the company owns the asset. So you own your pro rata share of the profits. Wealthy people, they don't own retirement funds. Those are just retail products, right? They own pieces of businesses. And that's the key difference.
Yeah, okay. So if someone's watching this and they're probably looking around different opportunities and they're not sure about yours or sure about anything, what would be those common mistakes that you would recommend people to just avoid, or things that could potentially happen in this space?
Well, investing with the wrong people, right? If I was a passive investor, I would put my criteria on 50% the numbers, 50% the people. I look at the numbers first. I'm able to analyze the deals, but there are things to look as a passive investor. You're not going to be an underwriting specialist, but there are things to look out in the underwriting that I teach in my syndication e-course. I also have a light course that's free that people can check out on my website. But there's ways that kind of get a little bit sophisticated. But then I think you need to get yourself up to a certain education level and start to build your network around you of other pure passive investors, right? And this is why I've created the Hui Deal Pipeline Club and our mastermind, because the power is in the network. The power is you having people you trust organically, that you have organic relationships with, that you can go to, hey Lynn, who have you been investing with? Oh, I'm investing in these guys, but stay away from these guys. These guys rob me, right? This is so important, right? Whether it's just like working with vendors, getting referrals, it's no different. Let's face it, right? You can kind of digital market your way to looking like you're a legit business. It's really hard to tell who is a legit institution that's been around for decades, who's a good boutique syndication company, I think how we are, who's done over 30 deals, handful of them full cycle, and who's somebody who's just getting off the ground. They just took an education boot camp or something like that and are on their first, second, third, fourth, fifth deal. I don't invest with anybody unless I know, like, and trust them. And part of that is having somebody in my personal network that has invested with these people in the past. it's taken me a while to develop my network. I mean, I've invested in a couple of deals where they went south because they just invested with the dishonest people.
Yeah, and that's what I love about your program is that you've got that course and consulting, and people can really learn and educate themselves. And even if they wanted to invest themselves, because you're not there just to go and take their money and invest for them, but it's only if they want you to, invest for them through the syndication, through whatever, then you have that service. So it really does show that there's so much transparency there, whereas sometimes people are just selling that pitch and you're like, oh my God, because sometimes you go to a seminar and the person just goes, they sell it to you as if like, even if you're broke, don't worry, I'll make you money and da, da, da. It's like, it's all promises and testimonials. And then you're like, where's the good? Like you still see so many people fall for that. And I'm like, no, it's just a sales pitch.
Yeah, real estate like seminars are like the worst, right? Like they get people, they prey on people based on hope, right? They often, unfortunately, they go after people who can't afford the $30,000 program or whatever it costs. On the other hand, like the stuff that I do, passive real estate investing, whether it's rental properties or syndications, you need money, man. And you guys aren't stupid people. You guys like have all these marketing tricks ain't gonna work on you guys. But once you're educated and you understand how to be a sophisticated investor, you're gonna move forward quickly. And that's where it's, at the end of the day, the way I see it is just being honest, being transparent, and just educating investors to be the best investor they can be, whether they work with us or not.
So just last question, is there any limitation to audiences that are not American? So let's say they did your course, is it still applicable to if they were trying to invest locally, or if they wanted to invest in properties, if they're not from America, but they want to invest in America with you? Yeah, any limitation around that?
I don't think so. I mean, at the end of the day, like people need a place to live, and the underwriting. I mean, people can go to my website, download my analyzer for free, and you guys tell me if it's different. I think something I learned from wealthy people is like the most boring, archaic businesses are the ones that do best, such as buying a rental property and renting it out to somebody at the market rate. Right?
Yeah.
And the nuances are simply like there's going to be things that break, there's going to be vacancies, you have to pay a property manager, you have to put some money away in an account just in case the roof breaks or when it breaks, AC breaks. And I think the important thing is, after you found the property that meets that rent to value ratio criteria, is like you put it into the analyzer. Now you start analyzing profit and loss. If people want to get that, thing, go to simplepassivecashflow.com/analyzer to download that for free.
Sounds awesome. So where else can people find you? So you've got the analyzer. You give me the link anyway. I'll put it in the description. And where else can people connect with you?
They can find me at simplepassivecashflow.com, and then the podcast is Simple Passive Cashflow.
Awesome. Thank you so much, Lane. It was awesome hearing all that insightful information about finance. And I'm going to get my husband listening to this. He loves property, but yeah, I just want him to, learn from the best like Lane.
Thanks for having me, Lane.
Well, thank you so much for watching, guys. If you have any questions for myself and Lane, please leave it in the comments below. Do check out all the links in the description as well. And if you like more videos like this, please check it out here.